Continue the conversation as we're tracking the tick by tick going into and during the FOMC and Fed Chair Jerome Powell's comments, and to help set the stage for where the Fed goes from here in its dual mandate. We have Andrew Levin, who is the former Federal Reserve Board Special Advisor and Dartmouth College economics professor. Great to have you here with us today. First and foremost, just want to get your reaction to the Fed's decision, and given where we saw the Fed line up both prior to this decision in some of the FOMC members looking for 50 basis points, dialing that back a little bit because of the international conflict, and taking all of those things into account. Your reaction to today's announcement?
Well, first of all, our hearts go out to Ukraine and the people who are suffering there, and really hoping that that situation will be resolved soon. No question that that's putting a lot of upward pressure on inflation worldwide, grain prices, energy prices, lots of other raw materials affected by this. That increases the motivation for the Fed to try to move promptly here. Now, you look at the current forecast they have, they are expecting core PCE inflation over this year to be 4%. And they're expecting to bring the federal funds rate up a little bit above 1%, 1.5%, somewhere in there, okay? That's a very accommodative policy still at the end of this year, a very stimulative policy. I would say that the Federal Reserve under this plan is actually going to be adding fuel to the inflationary inferno. They're going to be adding fuel to it. They're not going to be helping to reduce inflation. They're going to be adding fuel to it because they're not moving promptly enough. What a neutral stance would be, roughly speaking, is to bring the level of the federal funds rate up to be similar to the level of inflation. Okay, that will take some bigger moves, some 50 basis point moves. Now, as far as the balance sheet goes, I'm a little more skeptical, but I'd be happy to talk about it. The main thing here is the Fed is way, way, way behind the curve.
That being said, we're awaiting remarks from Jerome Powell about 9 minutes away. What would you like to hear from the Fed chair, and what would shock the markets?
Well, I think the challenge that he has is actually because they're so far behind the curve, they're trying to catch up in stages. So the dot plot will move again at the May meeting, and again at the June meeting, and again at the July meeting. And maybe by September, we'll actually see a more realistic trajectory for policy, which is that they really need to bring the policy rate up close to the level of inflation to make sure that they're not adding any more monetary stimulus in this circumstance. The truth is inflation could go up a lot further. It's running at 7%. Consumers are expecting inflation to be 7% over the coming year. And that's feeding through into wage and price negotiations and wage and price setting. Okay, with all the pressures on commodities that we've been talking about, again, we could be heading toward double digits, in which case the Fed will be even further behind the curve. So they need to move promptly.
And Andrew, I want to talk about perception of where inflation is headed, because in your notes, you highlight that financial market participants expect inflation to average 3.5% over the next 5 years, nearly double the Fed's target. But for consumers, so much more pessimistic. They're expecting it to still be running at 5% 3 years from now. What kind of domino effect does having those perceptions have on the economy?
Well, I think that unfortunately the Fed has tended to downweight consumers' expectations. And in some circumstances, that may make sense. But right now, what's happening is that workers are having conversations with their employer, their supervisor. I need a cost of living increase. Food, energy, gasoline, rent prices are going up a lot. Ordinary workers want to get a 5, 6, 7, 8% pay increase just to keep up with the cost of living. We're not talking here about greedy workers. We're talking about just trying to keep pace. And so if consumers are expecting inflation to be 7% over the coming year, they're going to be asking for a lot of pay increases of 7%. And that does create a dynamic where it makes it harder and harder and harder for the Fed to bring inflation back down toward the target.
Just lastly, while we have you, data-dependent Fed, this data, some of it going to be lagging. Likelihood of a recession while the Fed, is midway into tightening?
Okay, I'm worried about what we call stagflation, which is the economy will slow somewhat. And it's probably going to be difficult for the Fed to bring inflation down without having some significant noticeable slowing of the economy. That's not the same as a recession where unemployment starts heading way back upward again. That would be very unfortunate. Part of the reason for the Fed to move promptly is to make sure that that doesn't happen. having some slowing might be part of having a healthy, what people call soft landing here. So again, the Fed faces some big challenges. This is part of the cost of having waited so long before reaching today of making the first baby step toward normalization.
Andrew Levin, former special advisor to the Fed, economics professor at Dartmouth. Appreciate your insights today.